Have you taken control of your financial education yet? Well, now is the time. Take control of your financial education. Start living that debt-free journey. This is a compilation of the entire works week, and I hope you enjoy it. How does your wealth preservation strategy look? Do you have one at all? When it comes to the ultra wealthy, they not only have the ability to get rich, but they have the ability to stay rich. And of course, that doesn't apply to only the ultra wealthy, but it applies to you and I to benefit from the strategies that they do utilize. And in today's video, we're going to be looking at how to stay rich, the 8 ways to preserve your wealth for you and I. So we understand this. Let's start with number 1, creating a financial plan. This is really the basic. This is the foundation, developing a comprehensive plan and what it includes in its entirety to manage not only short-term and long-term goals, but we're talking about managing income, expenses, investments, debt, and also collections of taxes. So what can you do for this? First point, listing out your goals. This is going to be very clear, concise goals when it comes to financial planning, saving up for buying a home, saving up for retirement, college planning, regardless what it is, you are going to set that goal. You're going to write it down. You're going to know exactly what it is. And I do this with sticky notes. They are actually stuck to my keyboard, and we know exactly the way that we're headed. Second one, creating a budget to reach the goal. This, of course, is a detailed budget that outlines everything. A budget, a spending plan, whatever you want to call it. You have to know the money that's coming in, the money that's going out, and exactly what you have left over. If you don't know where you're at financially or you don't want to face it, it is time to take accountability, sit down, figure out the budget and exactly where you're at. Now, of course, third step of this, building that emergency fund. When you start thinking of the emergency fund, this is what is going to help with the preservation of wealth. If you have an unexpected financial expense, 3 to 6 months of really living expenses put aside in a liquid savings account. This doesn't mean investment account, doesn't mean CDs. This is looking at a high yield savings account where the money is liquid in case of that emergency is going to be your backup plan. Fourth one of this, investing in the future. This is going to be retirement plans. We're talking about, your 529s, your 401ks, the taxable brokerage account, making sure that a certain percentage of your pay is earmarked towards retirement. And then as your life evolves, let's say you get married, you buy a house, you have kids, you want to make sure that you're reviewing and looking at this financial plan on a regular basis and making adjustments as needed. When you bring another person into the equation or kids in the equation, definitely time to look over that financial plan. Now, the second one, diversification. This goes back to the old saying, don't put all your eggs in one basket. But when it comes to building wealth, diversification is key. And it's more than just understanding what you need to invest or where your 401k is. We are talking about stocks, bonds, real estate, alternative investments, gold, collectibles, cryptocurrency, a lot of different things to really hedge where all your money is. For instance, if you put all your money into one single stock, which I do know individuals that do this, into one stock, if anything should happen where the stock goes down, the company sees a couple years of negative growth or anything of that nature, it can wreck your portfolio in the entirety. That is the reason why when it comes to diversification and very simplified diversification, I look at index funds and only index funds or ETFs. Mutual funds I like, but they're a little bit more expensive. When you track an index like the S&P 500, me personally, what I hold in my portfolio is the VOO, the Vanguard S&P 500. It works incredibly well, gives you exposure to around 500 stocks with a single purchase. You're not buying Apple, Nvidia, Microsoft. You're buying the 500 largest companies in the United States with a very easy instant diversification within that portfolio. Now, for a majority of people, 401ks, another very simple way is looking at target date funds. Now, me personally, when I start looking at ETFs in comparison to the target date funds adjust depending on your age allocation. So the older you're getting, the less riskier it's going to get. And the older that you do get in the closer to retirement, as the date nears, it puts a lot more money into bonds. It puts more into cash, really takes any of the guesswork out in the entirety, and it rebalances these portfolios automatically. Now, for me, like I said, personally, 3 ETF portfolio, making it very, very simple. Number 1, the financial or the foundational ETF. This is going to be your very easy S&P 500 fund. It could also be like a VTI, which is a total index fund that you could carry in there, which is going to be the basics. Second one is going to be the growth. You could look at the QQQM. You could look at the VUG. There are a lot that have a lot more focus on the tech side of it and the artificial intelligence side, which I know seems like in the future that is going to be a no-brainer. And the third one I carry of that 3 ETF portfolio is, of course, income-based, like the HG or VYM. They are the ones that I really focus on. You could also put a couple other ones in there if you wanted to, but I really recommend at a very small percentage if you are looking at doing this. You could look at the IBIT, which of course is the Bitcoin ETF. You could look at some of the REITs that are out there. You could do some of the other income, really an investing portfolio at a very small percentage. Let's say you do, 1% Bitcoin, 1% in some REITs, or 1 or 2%, depending on where exactly your risk tolerance is at. Number 3, maintaining a healthy cash reserve. Now, this is really understanding the importance of liquidity, having easy access to the money. And of course, this is where the emergency fund is going to sit, but it also allows you to cover expenses or cover shortfalls without having to liquidate investments. If we have a year where the market is down 22%, like we've seen in 2021, you don't have to liquidate those investments at a very big loss. This is the reason why having those high yield savings accounts, I personally use M1 Finance. We have a link right down below, but definitely keeping it there, or the money market fund. You want to make sure that you're beating out inflation with what you're getting out of there. Good rule of thumb, we talk about 3 to 6 months of cash on hand. That is what is going to sit in the emergency fund. If you have an unexpected expense that comes up, the cash flow is going to be there. You can manage it through not only having the ability for the payroll, the income, the regular 9 to 5 job that you have, or the side hustle you're using, but making sure that you're getting the most for that money. Fourth one that we look at, minimizing taxes. The rich get very creative with taxes. That's why a lot of people say when it comes to being rich, the rich don't pay the taxes. You know what? When you start looking at the capital gains tax, let's say for instance, you had zero income. You had no job, you didn't have anything, you had zero income, but you had a really strong, solid investment portfolio. As it sits right now, married, filing jointly, you can take up to $98,000 as it sits right now. With that $98,000, you will pay zero capital gains tax. That's right. You could go ahead and get some passive income. You could get a dividend portfolio. Let's say you got $2 million in the HD. You could take almost 100 grand out of that every single year, and you would pay zero capital gains on there. Pretty incredible to think that way more than the average income of American is you could take that money out and have it. Now, of course, when we start looking at taxes, this is where it comes into IRAs. It comes into our 401ks. Really a good place to start. But honestly, for me, when it comes to taxes, I want to pay my taxes up front. When it comes to the Roth IRAs, the Roth 401ks, I do want to pay them up front because I know when that essentially big nest egg grows even larger and larger and larger, I don't want to be required to take RMDs. I don't want to worry about what the tax brackets are going to look like in 40 years when I retire. I want to make sure that we're getting it and really paying it what it is now. Now, a lot of people also do tax harvesting. Now, I haven't done a lot of research about this, but tax loss harvesting helps offset your capital's gain tax by selling things at a loss. Now, financial advisors can do this. And I also noticed that there was a couple things, I believe it was over in Robinhood, which I have a link down below as well, that did have the ability to tax loss harvest quite a few things. Number 5, creating a comprehensive estate plan. Now, estate plan isn't just for billionaires. Powerful tool, very important to protect your assets, ensure their wishes are carried out once you're gone. If you don't leave a plan or don't leave something that says exactly how your assets are going to be taken care of, you want to make sure that you know what it is and you know exactly how it's going to be, regardless of your net worth. You don't want this to be going to probate court. You don't want to leave your family with all of that hassle. Now, no matter the side of the estate, creating a will and assigning beneficiaries. This is a thing, being in a financial institution, working in the banking side, that I see places and people that do not have beneficiaries at all anywhere to preserve the money that is in there. So unfortunately, let's say for instance, in your bank account, you don't have any beneficiaries, something happens to you, that account will go to probate. That is right. It is going to go to probate. Chances are, even here in the state of Michigan, they are going to take a certain percentage of that in the probate court after your family files all the paperwork, all the fees, everything else to file and get the probate court. And of course, when it comes to privacy, when it comes to reducing the taxes, you want to make sure that your family has access to the money, because if they have funeral expenses, month-to-month costs, they might not be able to get that money if it is sitting in probate. Number 6 is insurance. When you start looking at insurance and managing risk, this is exactly what insurance is, guys. By design, when you think of devastating your finances, it can come from insurance, similar to what we see with a vehicle. You are insuring your auto loan, your car itself. If it gets into a wreck, you have insurance to cover it. But looking at life insurance policies, looking at term life, looking at whole life, this is the premiums that are going to cover the replacement of your income. God forbid something should happen to you. It has the ability to cover in a short term or even a long term, depending on the policy, to make up that income. For instance, if you're an individual making $50,000 a year, something happens to you, what is your family going to do without that $50,000? That's where the life insurance comes in. If you have a policy, let's say $250,000, that gives them 5 years of coverage and expenses that they can cover with your loss of income, making sure that your family is set until they can financially get back on their feet. Number 7, talking to financial professionals. When it comes to the financial advisors, the accountant, the estate attorneys, the insurance experts, you have to make sure who you're hiring. Do they have you and your family in their best interest? This, of course, is something that you need. Me personally, I have a financial advisor, I have an accountant, I have an attorney. We have everything that we need because they are the best of what they do. And they know exactly what we need with investments, with my financial planning, and also constantly evolving and changing depending where we are in life. The financial professionals that you pay for, make sure you're getting what you paid for. And the final one, number 8, think generationally and plan accordingly. For a lot of people, they think, and everyone says, you can't take it with you, but guess what? You can leave it for your kids. When it comes to building wealth and really building good wealth, building a financial legacy, not just the finances that you have right now, that is the way that rich people pass money through a family trust or really build that generational wealth. When you start thinking of family offices, when you start thinking of a lot of the ultra wealthy, they can use this tool that really can be super beneficial, covering the expenses of your kids, even your grandchildren, when it comes to everything from grocery shopping, paying the bills. You can have someone manage it or manage it yourself and really make sure that the money isn't gone sooner than it should be. So the bottom line, guys, when it comes to building wealth, you not only want to generate wealth, but you want to have the ability to stay and really keep that wealth through generations. With having good financial habits, you can absolutely do that. Putting the money mindset into place and thinking strategically when it comes to wealth generation and, of course, preservation. So guys, that's going to do it for today's video, and I'll catch you in the next one. Have you ever considered what kind of investor you really are? Are you an active investor? Are you a passive investor? In today's video, we're going to be breaking down just that. And of course, put your comments down below. What kind of investor are you? So when we think to active investing, a lot of people think this is the way to make money versus the passive investing. After all, we're very prone to see the activity as more powerful, more dynamic, more capable of investing and making the strategies work. Active and passive investing have both positive and negatives. We're going to be breaking down in this video. And of course, when you think of investors in general overall, a majority of passive investors through index fund investing or ETFs are the most really profitable investors that we do see. So why do we think of that as we look at today's stock market and all the changes that we've seen, of course, with the presidential election? It has been absolutely crazy on fire when it comes to everything, looking at bonds going up, looking at the stock market going up, your ETFs, your cryptocurrency, everything across the board has been investing and really going up today. So what exactly is active investing? Now, this is what you see, the films, the TV shows, all the glitz, all the glamour. This is when you try to time the market, when you're doing buys and sells, looking for something that is undervalued, gonna purchase it, ride it till it builds up a little bit, sell it when it gets high enough to take a margin. And this is what a lot of people are not only doing with stocks, but we are also seeing a huge rise of this with cryptocurrency, being able to trade that, essentially buying something, let's say at $50, you ride it out the entire day, you sell out at the end of the day for that $70, making the $20 profit. But of course, it involves a lot of analytics. It involves a lot of insight, knowledge of the market, how to do this. And of course, if you're a short-term trader, depending on how many trades you do, that could make a big difference on if you can and what you can buy and sell and what platform you're using. So thinking of the advantages of this, number one, biggest one for active traders and active investing is the higher returns. If you're skilled, the sky is the limit for this. If you're researching and you're investing, a lot of people even choose one single stock or one single cryptocurrency that they trade on a regular basis, looking at where the trends are and how they're going. But of course, this is also the big part, and the big disadvantage of this is you can lose a ton of money. If you buy something in that same scenario where you buy it at $50, by the end of the day, it's worth $20. Are you going to hold on to it hoping it's going to go up? Are you going to take the passive approach, or are you going to sell it at a loss of that $30? That entirely is up to you. Now, of course, another advantage is fun. To follow the market, to test your skills, it can be incredibly fun, but it can be incredibly time consuming. I used to trade cryptocurrency, and that's exactly what it was. Trying to time the market, making money kind of little by little when you only have a little to put into the market made a big difference, but emotionally, it was an absolute roller coaster staring at the charts every 15 minutes, 30 minutes, every hour, seeing exactly where they're going and where you think they're going to be trending. So what are some of the disadvantages to the active trading? Hard to beat professional traders. Even when you think of the S&P 500, and we always go back to Warren Buffett, he said 90% of the traders over an extended amount of time cannot beat the market itself, like the S&P 500, meaning it is very hard. Now, if you're a good day trader, again, the sky is the limit with the amount of money that you can make. High powered, high speed, really data, the more you can take in and the faster you can do it. And a lot of people are doing this now with artificial intelligence and a couple other tools, including bots. Now, another disadvantage, most active traders, like we said, do not beat the market. Reporting the S&P Dow Jones, 60% of US managed funds and large companies underperform the benchmark. So again, kind of crazy according to 2023 data. It can require a lot of skill, and it can run up a very large tax bill if you're not familiar with it. If you have a lot of gains, chances are you're going to have a lot of net gains. You might have a lot of capital gains, and you could have a huge tax bill out really at the end of the year. It could take a lot of time, and investors often buy and sell at worrisome times. This is the opposite that really people need to be investing in. People do need to be buying. When you think of human psychology, it is focused on minimizing the pain, meaning, again, when we use that scenario, buying that $50 stock, you start seeing it go down. Guess what? You want to sell. It gets to, $30. You want to sell. $25. You need to sell. 20. You have to sell. Boom, you're out. You're completely done. You're never going to do it again. But the best part and the best time to buy it is when it's going down. That is the way to make the most of your money, is when you start seeing the stock market, let's say it's at 100%, it goes down, it drops 10%, now you're at 90%, perfect time to buy. You're gonna get a 10% discount on everything that you're purchasing, which for a majority of people, very counterintuitive to look at it at a discount, and that is not how most people do view the stock market when it comes to investing. Now, my favorite form, and the one that I use, what is passive investing? When we think of passive investing, it is the long-term hold. When you think of ETFs, when you think of stocks, when you think of cryptocurrency, Bitcoin, Ethereum, the buy and hold strategy is the long-term approach. This is when, especially when you're buying index funds, we are looking at 5+ years. It is not going to be us kind of churning over different ETFs, getting capital gains, doing buys, doing sells. And you want to go ahead and buy, and this is what I recommend, into ETFs like the VOO, the S&P 500. I do not want to hold individual stocks, and I do not hold any individual stocks at all. The reason being, when I buy an ETF, it is instant diversification across all of the sectors of the market, and making sure that we have, a little bit heavier into tech, which is usually leads to not only bigger market cap, but it also leads to a lot of growth. And of course, I'm not too worried about outpacing the index, beating the market. I at least want to get that 10% return that we have seen from the S&P 500. So what are the advantages? Beats most investors over time. That is the big thing. Passive investors are trying to beat the market instead of just taking the market and really being the market makers. They want to do it themselves during the index funds, different stocks, different bonds, depending on their holding. But of course, the S&P 500 average return is about 10% over an extended amount of time. Most people cannot beat that. They might have a year or two where they do, maybe a year or two where they underperform. When you start looking at the averages, most financial advisors cannot beat that. It's easier to succeed at. This is one of the big things. When you think of passive investing, when you're putting money in, dollar cost averaging in, for me, I put $250 in every single week on Monday morning. That's it. Get it and forget it. As long as I have an account that has enough funds in my high yield savings account, it is going to continue investing $1,000 every single month or $1,250 depending on how the weeks fall. But overall, I don't have to do the legwork. I'm not doing the research. I am just letting it, very low fee index funds, putting it in that VOO, putting it in the VUG, being a passive investor and putting it in there, which of course is the approach when you look at Warren Buffett, keeping the money in there. Now, in addition, you have deferred capital gains tax. This is another one that they are deferred until you sell. So you don't have a really big tax burden and you know exactly what you're going to. Now, required minimum time, best case scenario, investors are looking 15 to 20 minutes tax time every year. When they're done with the investing, again, it's very easy. I just put money in and let a company's success drive your returns. That is another big thing. When you think of a company's success, when you're buying 500 companies in that S&P 500 fund, it makes a big difference. If you have 300 that are doing well, 200 that are underperforming, essentially the weighted average, depending on which companies those are, you are still going to see and get the average return. Now, this can also be viewed as a disadvantage of passive investing. You get an average return. You're not getting, the 30, 40, 50% return. You're not seeing the returns that we get from cryptocurrency. We are looking for our very slow, boring portfolios, as a lot of you have mentioned. My very slow, boring portfolio, that is doing incredibly well. You know what? I'm up 80% in the last 3 years and 1 month, which is kind of crazy through dollar cost averaging. In 2021, when the market started declining, I bought it every single week like we're doing right now. I was putting a lot of money in there every single week. So all the way down as the market declined, we did invest in there. Then, of course, when you start looking at 22 and 23, markets started rebounding, started coming back. I owned exponentially more of the ETFs that I was investing in, and it makes a big difference. And I will continue that dollar cost averaging until that money is gone, which is getting replenished every 2 weeks. So it's never going to run out until I retire and quit doing contributions in there. Now, of course, the other disadvantage, you still have to know what you own. You have to do your own research. You have to know and understand the risk, what you're putting into the ETFs, what you're putting into your portfolio. And of course, a lot of ETFs, if you're taking that long-term approach, there usually isn't a lot of change. Even thinking of something like a dividend ETF like HD, it is rebalanced or adjusted one single time a year. That's it. Talk about a get it and really forget it. As long as you're putting money in there consistently, you're getting a pretty good yield, about 3.4 to 3.6%. You're getting a pretty decent yield. You're also seeing a lot of value, getting some growth out of that ETF. And overall, you can just put your money in there and kind of forget it. So active versus passive, which strategy is really best for you? This comes down to the individual, and this is where you got to sit down, think about your goals. So when active investing is better, you want to spend more time doing it, you enjoy doing it, you like the rise and the falls, you're doing your research, you can really outguess, millions of smart investors that are out there. You don't mind the losses, because if you cannot stomach that, definitely active investing, and again, I've done this before with crypto, is not for you at all. You're looking for mastery, you're looking how to read charts, you're looking how to really pace the market or kind of forecast which way it's headed. Then when it comes to the passive investing, if this is the investor that you are, you want good returns, willing to give up the chase to really get those best or those high returns. You want to beat most investors, even the pros, most of the time with those S&P 500 funds. You're comfortable investing in those index funds, don't want to spend a lot of time, want to minimize that tax liability. And of course, you want a hands-off approach. Similar to me, when it comes to investing, I do passive investing in its entirety. I don't do any trading. If I trade, it might be a rebalance or it might be something that I add, like the Bitcoin ETF. But short of that, not really anything that I'm doing as far as the investing strategy, keeping it very similar, keeping it very slow and really steady with the 3 ETF portfolio, making it really a big difference, and it continues to grow. We're almost up to $160,000 in the portfolio, so doing incredibly well. So, all right, guys, so that is going to do it for the video. Passive versus active investing. Which kind of investor are you? Let me know in the comments and I'll catch you in the next video. Are you currently investing in ETFs or exchange traded funds? If you're not, now might be the best time to get into them. And in today's video, we're going to be breaking down the acronym, exactly what it means to have an ETF and why you should be getting into these. Now, when you think of exchange traded funds, it's almost what would happen if a mutual fund and a stock had a baby together. It's a pooled investment vehicle where you can contain kind of the best of what a mutual fund brings and what stocks have to offer. But there are some pros and cons to these, which again is kind of what we want to break down and making sure that you know what exactly exchange traded funds are. Now, an exchange traded fund is a basket of holding of a variety of investment that a manager chooses. Now, financial advisors can create ETFs on their own, like we've seen with Catherine Wood, and unfortunately her ETF is not doing well at all. But when you can find an ETF with just 25 of social media's favorite companies, you can put all those together. That can be your basic in an ETF that exists for a particular interest. Doesn't really make it a good investment depending what you put in there, because a lot of people put companies in there that they really think are going to do incredibly well. And unfortunately, they do poorly. Like I said, with Catherine Wood, the portfolio or the ARK ETF that she is running is down about 68% since its inception, which is kind of crazy. But when you start thinking of how other ETFs work, simply like the S&P 500, where it is an ETF or an exchange traded fund that is following the performance of a specific index. So essentially it is holding the exact same stocks that are held within that index itself, making it a really good strategy. When you think of an ETF such as the VOO, it is instant diversification, putting it and really investing in 503 of the largest companies within the United States. So it's pretty neat how an ETF works. Now, working very similar to a mutual fund when it comes to individual stocks, when you start looking at an ETF, it may look, again, kind of similar to a mutual fund. But the thing with the mutual fund is it can come with a bigger price tag. It can also come with a bigger management expense. That is the reason why I know Dave Ramsey always pushes towards the mutual funds, but I push towards the ETFs. Now, the other big thing with ETFs is they can trade throughout the day. Now, a lot of people might not know this. When it comes to conjunction with mutual funds are only traded at the end of the day, where ETFs or the value of the ETF can be changed and exchanged throughout the day, which makes a big thing. So ETFs can trade at a premium or a discount depending on the time of day that you're buying them. Because if it gets towards the end of the day and it's a much higher value, then you're going to be paying a much higher premium on that mutual fund if you do have to wait to the end of the day versus buying the ETF when it is available or when you want to get into the market. Now the question comes, ETFs versus stocks. So this is a little bit different. So although ETFs trade like stocks, they can even be made up by a collection of stocks like we see with that VOO. They are not the same as owning the company itself. Now I want to explain exactly how we think about this. So owning a stock, let's say Coca-Cola, Nike, a publicly traded company, when you buy stock in the company, it gives you a piece of the company, even if it's a small piece, if you just own a couple shares, and those shares have certain privileges, such as voting rights. Now, of course, when it comes to ETFs do not have voting rights. For instance, again, and I'm always going to use the point of reference of the VOO, you have NVIDIA in there, you have Apple, you have Microsoft, you have Alphabet, you have all of these companies. Because you own it in an ETF, you do not really have no voting rights within those companies because you are owning it in that ETF and not the individual shares. When you buy the ETF or own a piece of an ETF, not the securities within the ETF, that is the big difference. You are not technically owning the companies that are enclosed within that ETF. You are just buying and holding the ETF itself. For example, if you have a share of an ETF that holds Coca-Cola, you own a piece of the ETF, you do not own a piece of Coca-Cola. You cannot vote on anything that the company really has and presents to its stockholders because you do not own Coca-Cola. However, the caveat to that is the ETF managers may be able to vote in your place, essentially from not having it. You'll still profit from Coca-Cola from the stock going up. You'll profit from the dividends that Coca-Cola is paying, and the ETF and the fund manager will pass it along to you and the other investors that are invested in the ETF. Again, very similar to a stock, but the big part of that is some of the trading commissions or the fees that could be associated with it, in addition to not having and removing those voting rights. So how does an ETF compare to a mutual fund? Now, these two are probably two of the big securities that are very, very similar. When you think of ETFs and mutual funds, they are pooled investment vehicles. So putting all of those together. And the key difference is one, how they're traded, like I said, and what they cost. This is where it comes in. So mutual funds, like we had noted earlier, they trade once a day at the market close. So if you place it, let's say at noon, if you place it at 9 a.m. to buy a mutual fund, it is not going to purchase it for the entire amount of day, which you really don't know what price you're paying for the mutual fund until the market actually closes that day and knowing what that final price is. Now, of course, if the price skyrockets, you just missed out on all of those gains. If the price does dip, you just bought the mutual fund cheaper. So it can have kind of its pros and cons when it comes to that. Now, when it comes to the mutual funds, again, it is very specific on dollar amounts. They don't have the fractional shares that we see with ETFs. So you can't buy, a 0.01%. It is a $50 fund funding of X. And the compensation, mutual funds, again, are full dollar amount. So if you're looking to get in, could be a little bit more expensive. As with stocks, you typically buy ETFs on a per share basis. Although a lot of brokerage firms, including M1 Finance, which we have down below, have a dollar-based investment. So again, you can buy those fractional shares of the ETFs. Now, of course, mutual funds, very similar to ETFs, both of them have management costs or an expense ratio. So a company putting together different ETFs can make you pay money somehow. That is the expense ratio that we see. And it's very important when we start thinking of a 0.03 like the VOO, very, very cheap when it comes to an ETF. When you start looking at the mutual side of it, mutual funds run usually about 1.5% for the mutual funds because they are managed funds. Now, mutual funds could also have other charges that you have to be aware of, as sales loading, distribution, marketing fees, or redemption fees if you buy or sell those mutual funds. So definitely do your own research, know exactly what you're investing in before you get into it. So some of the questions that I get, number one, do ETFs pay dividends? Yes. If the ETFs do pay dividends, they can pay it monthly, quarterly, really whatever schedule the ETF manager chooses. Thinking of like a JEPI is one, for instance, that does pay dividends and it pays it on a monthly basis. So not similar to like an HD. When there is a qualified dividend every single quarter, you do get a return from that based on the bucket, and of course could be eligible or acceptable to capital gains tax. So again, know exactly what you're getting into. Types of ETFs, this is where it gets very, very interesting, which I invest in passive ETFs. When we think of passive ETFs, you're thinking of the market index like the S&P 500, or even thinking of something like the QQQM that follows the NASDAQ 100. It is following an index. It is not going to be actively decision about what to buy, what to sell, what's going into that ETF. It is just going to follow it and really hold the exact same weighted average, what you have within that index itself, and that is going to build the ETF. Now, there are also active managed ETFs. Now, the thing with active managed, this is where the fund manager or the one that is running the ETF does the buys and sells when they see fit, and they can do adjustments to it. They can do trades, they can do changes, and they are doing it to really ensure that the ETF does better than the S&P 500 because you always want to try to beat the market. Now, for example, on this, an active ETF could provide a little bit of a higher return in the bull market, minimizing or changing the stock portfolio that's in the ETF within a bear market, or provide higher dividends depending what you're in. And of course, the big thing with active ETFs is a majority of them do have a much higher expense ratio because of that cost. Now, there are also stock ETFs, which again is built of complete stocks in the companies. The S&P 500 ETF is a stock ETF that can hold thousands of stocks or just a handful depending on exactly how they built it. Rather than just holding one stock, you can hold a basket of stocks, which comes to some of the industry sectors. Even let's say, for instance, you want to invest in artificial intelligence and only in AI. There are ETFs that kind of encompass all of the companies that are embedded in really building, development, implementation of artificial intelligence. You can really break it down into sectors, looking at, if you want international, if you want small cap, if you want large cap, if you want industrial, if you want finance. There are so many different ways that you can split all the essentially stocks we have within the stock market to build the ETFs. This can be the exact same when it comes to bond ETFs, very similar to what we see with stocks. They can do the exact same thing with bonds. When we start thinking of government bonds, corporate bonds, short-term bonds, long-term, domestic, international, there is a different bond manager, different ETF Similar again to putting together all of those stocks, they're putting all of the bonds into the ETFs, but there are also commodity ETFs, there are sector ETFs, leveraged ETFs. There are so many different varieties when it comes to ETFs. And essentially, like I said, they're taking all of these companies, they're bundling them in a very different methodology. And really, the fund manager or the individual that is running the ETF is responsible for what is happening in that ETF. And again, going back to Catherine Wood with the ETF with ARK Investments, unfortunately, I don't know why there wasn't any changes or anything like that, but that is one I know that some people have commented on how that performance and really what it is. So to sum it up, guys, when we start looking at ETFs, some of the pros: accessibility. When you have a brokerage account, just like M1 Finance, you can get into ETFs, easy to trade, very transparent. And of course, they have a really big tax efficiency when it comes to ETFs, a lot more tax efficient than mutual funds because the ETFs tend to have lower capital gains distribution, which are taxable to investors. So make sure you do your own research. But on the flip side of this, and the cons, commission. Sometimes when buying or selling ETFs, there could be a commission. The bid-ask spread, this is another one. You have to make sure you know the ETF, really the creator and the ownership, who owns it, who manages it. Do you trust the individual that runs it or that manages it? And what exactly does it look like? So some of the ETFs, depending on the ability, they also talk about illiquidity. So when you have an ETF and if there's very low trading volume, you might not be able to unsell or sell the ETF itself at a fair market price, or you might have to take less for it. And of course, the closure risk. There's also a possibility that an ETF you buy could just close. And if you're unable to bring in enough assets to cover its operating costs, you could be responsible for them. So guys, ETFs are the only way that I invest. Now, the reason I do not own the individual shares is one, I don't look and really dig that deep into a Warren Buffett level when it comes to owning individual stocks. ETFs keep it very simplified. They keep it very hands off. I'm not one that wants to spend, 3-5 hours a day looking into companies, looking into projections, portfolios, whatever it may be, even looking at prospectus. I don't want to spend the time and effort to do that. I would much rather be invested into something like the Vanguard S&P 500. Putting everything in that VOO really makes sense. Even when you look at Warren Buffett, he said 90%, and it's been proven through time, 90% of financial advisors cannot beat out the market over an extended amount of time. So if you think about all of the fees and everything you pay to a financial advisor, you might want to second guess it and think about what ETFs do have to offer. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching. Debt isn't just a source of our financial stress. It can make your everyday living less enjoyable, with a significant portion of your time and your paycheck going to repaying that debt. Now, focusing on debt can not only save you money, but it can also improve the quality of life. During this time, you have to avoid taking on new debt and building up an emergency fund so you don't have reoccurring debt. But in today's video, we're going to be breaking down 6 different ways to pay off debt faster and eliminate it in its entirety, starting with our first one, paying more than a minimum payment every month. When it comes to debt repayment, when you think of credit cards, most of the time you look at those statements, it says it's going to take you 15, 18, 20 years to pay off the debt if you make that minimum payment, which is the reason why focusing on even a small amount towards that debt can pay it off exponentially faster. When you think of minimum payments on revolving debt, credit cards are typically only paying a fraction of the principal balance, meaning you are going to carry that forever. Making larger, more consistent payments are going to and will eliminate the principal and really take down the debt that you owe overall. For example, let's suppose you have $5,000 in debt and you're at 20.99% APR, which is kind of crazy, but it is about average or a little bit below average as we're seeing it today, and $138 minimum payment. It will take you almost 5 years to pay it off, making that minimum payment. 5 years of your life to make that minimum payment to pay it off. If you put $300 towards it every single month, it is only going to take you 20 months to pay it off, and you're saving almost $2,000 in interest. When you think about your hourly wage and think about how much $2,000 really is spent in time, it makes a big difference. You can also pay more than that minimum amount on any of your loan types. When you start looking at your auto loan, your credit card loan, your personal loan, but even when you look at student loans and mortgages, anything that you're paying extra is going to come off that principal balance, and anything that is coming off that principal balance means you're paying it off faster. Now, the second one we look at, setting up a payment plan. rather than just throwing extra money towards it randomly, which is what people do. And I see this through financial counseling all the time. Takes it very more efficient if you map out exactly how you want to do. And of course, this gets into the debt snowball and the debt avalanche method. You have to have a designated way to pay back debt. Now, the first thing I ask individuals that are borrowing, how do you plan to pay this back and how often do you plan to make additional payments? For majority of people, it's a deer in the headlights. It is a big question mark. They have, and if they take out a loan for 60 months, they intend to make 60 payments on it, paying the maximum amount of interest during that term. So looking and thinking of the general rule, we're going to go in here and use the debt avalanche. Me personally, this is the one that I use to eliminate all my debt in its entirety. List your loans and credit cards, including balances, APR, minimum payments on a spreadsheet. Very easy. Knowing exactly where you are can give you an accountability piece that is going to come in later. Prioritizing your debt, you're going to do them either higher to lower interest rate or the balances. Again, debt avalanche uses the highest APR at the first one and the lowest APR at the bottom. So when you think of having, let's say, 3 credit cards, 20%, 25, and a 30%, that 30% is going to get every extra dollar. Now, the reason for this is every dollar you're putting in there, you are getting that extra and much higher APR paid down faster, meaning you're getting more bang for your buck for every dollar you're putting in there. Now, of course, our next step, looking at the budget. When you look at the budget, how much theoretically or how much can you honestly put towards that debt every single month? Be sure to make all of the minimum payments on everything else. We're focusing on one and only one payment, one credit card, one principal balance at a time. When you start paying that down and paying it off, you will see that it does get easier once you start getting out of the debt snowball and start getting out of the debt really repayment schedule. It is a game changer for the rest of your life. There's a lot of calculators, spreadsheets, applications that you can use to make this easier. So definitely seek some of those out. Now, the third one we're looking at, tackling high interest debt first. This is, again, when you think of getting the most bang for your buck, the debt avalanche method is going to eliminate the most expensive debt that you have. And honestly, when it comes to a financial order of operations and really breaking it down, getting rid of this debt comes right after the emergency fund. Now, the reason for this is if you do not build an emergency fund, and I know a lot of people, kind of do this backwards. They'll be putting extra money towards their debt. They'll be putting extra money towards the credit card. Boom, an emergency happens. They go straight back to those credit cards, racking up the bills that are on there. Or the other thing we see is they'll put a lot of money on the credit card only to borrow majority or more of it back during the month because they put all the money on the card itself. Now, of course, when you start looking and paying off this debt, you have to make sure, like we said, having that emergency fund, but making sure you have a strategy, you have the game plan. When we start looking at the avalanche method, which again, that is the one that I love, focusing on that highest APR is going to have the most bang for your buck. Looking at number 4, adjusting your budget and eliminating unnecessary expenses. So this is the point where it's going to take a piece of accountability from you. It is going to take you, the more money that you can put towards that high interest debt, the faster it's going to come down, the faster you're going to be out of debt, the faster that you're going to have more money at the short-term sacrifice of really cutting back on expenses. This means reviewing your budget, your spending plan, whatever you want to call it, looking at your current expenses and looking where you can cut anything or really removing the discretionary spending. This doesn't have to be forever. This can be short-term, getting it out. So think of eating out, concerts, tickets, video games, spa visits, everything that could be maybe a little pinch point or a little point of pain, but eliminating those and removing them even for the temporary and really the long-term gratification of eliminating that debt. Now, when you cut out of that budget and really look at the bucket, you can also look at the necessary expenditures. Where can you get things that you can get for less? A lot of people don't realize when you look at a lot of fixed expenses and a lot of things that you're buying on a regular basis, there's a lot of different ways that you can get them cheaper. When we look at mortgages, could it be refinance? Could it be getting a lower payment? Auto loan, could it be a lower rate? Auto insurance, could it be cheaper insurance for the same quality product? There are a lot of ways to eliminate necessary expenses or reduce those necessary expenses while freeing up some income to pay down and eliminate that debt. You want to be strict enough with yourself where you can hold yourself accountable, but there are some areas, of course, that you cannot cut back at all that are going to still require you to be fully invested in there. Now, number 5, consider consolidating your debt. Now, this is one that I like, but it could be very counterintuitive depending on your spending habits, depending on your budget, depending on exactly how you do this. Now, when you think of debt consolidation, let's say, for instance, we're using that 20.99% APR credit card, and you're doing a debt consolidation, let's say the average of 5 different credit cards at $5,000 each. So you have $25,000 in debt, roughly running at 25% APR, which is pretty feasible. With the debt consolidation loan, you could consolidate that $25,000 into, let's say, a loan that's at 10% for the next 3 years. And in 3 years, guess what? The loan is gone. The debt is gone. Congratulations. You're completely debt-free with the credit card debt. It is gone in the entirety. The catch to this is a lot of people will do the consolidation with freeing up areas, or really freeing up the balances on those credit cards. They will continue to use the credit cards. So if you're an individual that's making $5,000 a month with credit cards, all of your liabilities, all of your expenditures, you're spending $6,000 a month, you're negative $1,000 cash flow every single month, which means you're going to have those credit cards to keep it afloat. And that traditionally is what we are seeing. Now, of course, debt consolidation loans also have to have a higher credit score to qualify for those lower rates. You want to make sure it makes sense. Is it going to be a payment that's going to be feasible? Is it a payment majority of time that is lower than those minimum payments on the cards? And how fast can you tackle it? Really challenge yourself. So what I see again through the financial counseling piece is we'll have individuals that have credit cards, let's say all said and done, their monthly payments are $500. They do a consolidation loan. Now their monthly payment is $300 because they wanted to take it out to 5 years instead of 3 years. So at a $300 payment, they are saving $200 every single week. And guess what? Or excuse me, every single month. But guess what? They go right back to credit card spending and right back to credit card debt. So now they have the credit card payments, they have the minimum payments on those credit cards, and they also have this personal loan on the side that they did for debt consolidation. All of a sudden, you fast forward 3 to 5 years, credit card balances are high again. We're still hanging out with that unsecured loan that we had, consolidation time again, doing it over and over and over again because they never changed the spending patterns in the first time. And number 6, keeping your debt out of collections. This is another one. If you're falling behind on loan payments, if your account is delinquent, this is going to tank your credit score. If you think the debt is unaffordable now, it gets worse. When you get into debt collectors, when you get into the things that they can do, you start tacking on late fees, you start tacking on interest charges, higher interest rates. You could get hit with collection agency fees. You could get hit with legal fees. You could get hit with such an incredible amount of things when it comes to collections. You could also be looking at garnishments, where they can actually come in, take the money out of your paycheck until that debt is fully repaid, which is kind of crazy. Also, tanking your credit score, meaning if you need a home, if you need a new auto loan, if you need anything, it is going to be exponentially more expensive when you go to get that. Now, of course, if you're dealing with these, you have to consider outside help, just like I do with the financial counseling piece. It is something we offer at a credit union. It is something that is totally and completely free. Be very cautious. Do your research, know exactly what you're getting into. We see a couple of places that do consolidation. They let everything go to collections. They work out repayments with some of the collectors. And overall, it tanks your credit card for an exceptional amount of time. And also, it is something that you can do entirely in your own being. You can do it yourself if you choose to, if you want the realization of the debt that you owe. The benefits of paying off this debt, when we start looking at a tighter budget, and again, for an extended amount of time, if you have to eliminate the debt, it is not incredibly easy, but you have to keep your eye on the prize. Just like we got back here, guys, the debt-free journey, being motivated, thinking of the future you. And I really take that in consideration. When I think of things that I'm doing where I'm purchasing assets, I'm investing in accounts, when I start thinking of what are my kids going to think, what is future me going to think, when I start eliminating and really knocked out all of our debt, paying down the mortgage exponentially to give us the ability and the financial freedom to live the life we want. And also, we're buying a lot of time back. That's one of the big things where if you're spending 40, 50, 60 hours a week at work, what is your time worth when it comes to retirement? And when it comes to really giving away your money, literally for debt, it is going to be crazy. So of course, you'll pay less in interest and more on principal. You want to get rid of it. You want to eliminate the debt. And of course, if you've ever been burned by it, you'll be an individual rate very quickly that will choose not to get back into debt by any means. Now, of course, when you start thinking of improving your life, debt elimination and really control is the big thing you're getting back. It is a very significant stressor in life. When you think about debt, when you think of being debt free, is not going to eliminate all of your financial worries, but it will give you some breathing room. You have the ability and really flexibility to live the life that you want and live it how you choose to. So guys, that's going to do it for today's video. Let me know in the comments what you guys think, and I'll catch you in the next video. When it comes to a 401k plan, for a majority of us, it is the biggest retirement fund that we're ever going to have. But does it make sense to take some of those 401k dollars, roll them over to Roth IRA dollars? That way you have the opportunity for tax-free growth, tax-free withdrawals during retirement, and also avoiding those RMDs. That's exactly what we're going to be looking at in today's video. Does it make sense to take some of that pre-tax money, move it over to the Roth variation, paying your taxes, of course. Now, a few pros and cons for this one. The big one, when you do the conversion, you're going to have to pay taxes. So depending on what bracket you're in, where you're at, does it make sense to move it over? When we start looking, it is a very dynamic shift that we're starting to see. And this was actually one of the biggest years in 2024 that we have seen a lot of people making the conversion from that 401k into the Roth IRA. Now, there are a few circumstances where it might not be appropriate, which I want to cover, and also some circumstances where it is absolutely appropriate. So looking at some of the reasons really not to do this is if you're very close to retirement. When you start thinking about putting money into a Roth IRA, you want it to grow tax-free, you want it to be tax-free, but of course, if you're putting it very close to retirement and you're gonna have a need to utilize those funds and using them to supplement Social Security, doesn't make sense at all to go ahead and make that conversion, paying taxes now with money that you anticipate using within a very short term. Now, once you do the conversion as well, remember there is a 5-year rule. That is right, 5-year withdrawal limitation on conversion. So if you're converting it, does it make sense to keep the money in there? So essentially what I'm doing, and I want to share it with you guys, breaking up a 401k and having a 401k in the traditional, getting a tax advantage now, also putting a portion into a Roth 401k or a Roth IRA as it sits today. So the anticipation is the money that is sitting in a traditional 401k is going to be what is going to be used and really shore up any loose ends or shore up any deficiencies that we see when it comes to the supplementing of Social Security. The Roth money, on the other hand, is money that is going to be absolutely tax-free growth that we don't anticipate to use at all. This is going to be the money that is set aside to build generational wealth, to make sure that we go ahead and have that on the side. And again, using some of the pre-tax money or that traditional money that is going to be achieved or really taken through RMDs. Now, Roth conversion strategies, again, doesn't make sense. This is where working with a skilled tax advisor, when you start looking at retirement funds in a 401k plan, they're subject to federal tax when they are withdrawn. This is where, again, a lot of people think the traditional funds, the traditional 401ks, when you add in the growth factor, the Roth is always the better option. The Roth variant is always the better option for 401ks and for IRAs because they could also be subject to state, local taxes, but it is the RMD rule and the requirement to take that. So for instance, let's say you start out, you're 18 years old, you're putting 15% or maxing out those IRAs, you start putting more money into the 401k plan. Now you start maxing that out, you start building a nest egg. All of a sudden, over the course of 40 years, you're now 58, thinking of 65 to retire. You're getting ready to retire. You have all of this money that is in these accounts. If it is pre-tax, chances are you could be looking at $2, $3, $4 million in these retirement accounts in their entirety. When it comes to the RMD, when it comes to you taking money out and taking money out if you need that money or not during retirement, you're going to have to pay tax. And of course, you're going to pay tax on the much larger balance that you're going to have from really that compounding that we're seeing when you start looking again at the biggest nest egg that you can think. When you start taking money out of there, it can create a very, very big tax burden for retirees, meaning that it could actually put you in a higher tax bracket because of the contributions and the growth factor. You could actually be earning more or paying more in taxes during retirement. And again, it's really very specific to an individual situation or a standard. If you're an individual that makes 50,000, let's say, you make 50,000 a year, you start putting away 15 or 20% in the course of 40, 45 years, you can far eclipse through RMDs what you're making at that 50K a year. And it's kind of crazy to think. Now, when it comes to the Roth, even thinking of that same scenario where if you're paying or if you're making that $50,000 a year and you're putting it into a Roth and putting it into a Roth, paying your taxes right now, by the time you get to that big balance at the end and ready for retirement, that money can grow and is growing tax-free. Compounding is tax-free. Withdrawals are coming out of tax-free. Now, of course, there is going to be some money, again, that you're going to have to utilize for retirement, but it makes sense when you start getting a big tax-free nest egg. Like Dave Ramsey says, always take the eggs, don't kill the goose. If you're looking at $2, $3, $4 million in that account, you can live off the interest 100% tax-free as long as you don't exceed the capital gains tax that is coming out of there, which again, depending on if you have brokerage accounts, Roth accounts, of course, are entirely tax-free, but you can make up some of the income. You can do a lot of very crafty things when you think about it. Now, the big disadvantage with really the Roth conversion, rolling over funds from the 401k to the Roth, is once the Roth account invested earnings qualified withdrawals are both tax-free. That, of course, is one of the big advantages, but Roth accounts are not subject to RMDs, which is better for retirement. You can control the funds and really use them where you need to. However, the big thing is the upfront tax bill. This is where, when it comes to high income earners, when it comes to individuals that have a significant amount of income, does it make sense to not take the tax benefit when you're earning $100,000, $150,000, $200,000 a year? Doesn't make sense to go ahead, pay the taxes up front, pay the taxes now, don't take the tax benefit and really go in for the Roth. For me personally, the answer to that is absolutely yes. Now, the reason being, when we start fast forwarding 20, 25 years, we don't know where the tax brackets are going to be. We don't know exactly what it's going to look like. So it doesn't mean locking and really entering everything into the Roth. Like I said, coming up with a strategy, coming up with exactly how this looks. For example, consider a single $100,000 earner in the 22% tax bracket, which is where they are for 2024, would pay about $14,000 in federal tax. If one year they convert $500,000 401k to a Roth, this is moving it over. The one-time tax bill would be estimated $177K, an increase of about $163,000. So this is where, again, it comes systematically with doing a strategy over a multitude of years to make sure you're staying within a tax bracket. So when you think even in this scenario, tax bill would be around $177K to transfer that $500,000. Now, if you take a different approach and really a stepped approach, again, taking that single $100,000 earner, converting $91K a year, moving into the 24% tax bracket, would have a tax bill of approximately $36,000, adding about $22,000 to their average bill every single year. 7 years emptying this account, which is kind of crazy, saving about $150,000, which is kind of crazy, or that would be the tax bill, approximately $150,000 for the overall tax bill. So when you think of the gradual conversion versus doing it all at once, you would save over $10,000 that would stay in that retirement account that you would have available when you're doing the conversion to the Roth, just by simply spacing it out for a multitude of years. Now, for instance, this is something that we did a couple years ago, had $50,000 into a IRA, a traditional IRA account. We converted $10,000 every year. And the reason why we stuck with $10,000 or a little less or a little more was to stay in a lower tax bracket. So we knew there's a dollar amount when you do your taxes. You can go ahead, you can mathematically figure out the conversion, where exactly it's going to sit out, how much you can, really contribute or convert without going into the next tax bracket and without paying a lot more. Now, when this was done, conversion strategies work incredibly well. Again, working with qualified tax advisors. Now, Roth conversion limitations. Now, this is where we talk about kind of the pros or the cons of this, which when we talk about Roth conversions are not always the best move. Now, a couple scenarios of this is retirees that know guaranteed they're going to be in a lower tax bracket when they get in there. And also, if you have a very, very short runway until retirement, because remember, they are subject to that 5-year tax rule after the conversion, making sure that you know exactly what you're doing, how you're moving the money, what money are you going to need, and really budgeting. When it comes to budgeting and knowing exactly what you're going to owe and what you're going to need on a monthly basis during retirement, what part of that is going to be Social Security? Is there going to be a pension? Is there going to be income you're going to have to draw out of these retirement accounts? What are you going to need to live and sustain the lifestyle that you do enjoy during retirement? And making sure, again, that you do work with a tax advisor, figuring out exactly the plan to get the money, but ultimately going into their tax advantage. Roth is really the good choice. Managing taxes, avoiding the RMDs, also paying your taxes up front. When I look at it, I think of it as kicking a can down the road. The further you kick it, you are looking at just sending that tax bill down the road, and every year, year after year after year, when you're making contributions, when you're getting the tax advantage, then of course you get in retirement, you're taking massive RMDs. Now you're in a whole nother bracket because of what you have to take out of there. And it might not even be money at that point that you do have to use. So guys, that's going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching. If you grew up absolutely broke like I did, you're going to have some very weird habits that you picked up from your parents or even from friends and family during that time. Now, this is an article from Psych Love that I want to cover because it is kind of crazy how coincidental the things noted in here really go hand in hand with what we do today. It is the people who grow up broke that have weird habits as adults. Starting with our first one, hoarding condiment packets. When I look at our pantry, when I look at drawers, we do have condiment packets from a bunch of different restaurants, really ketchup packets. We have sauce packets. You have a lot of different things, even looking at Taco Bell sauce. That comes from different places that is absolutely free, but it is hoarded to a point, and a lot of these, unfortunately, do not have expiration dates. And honestly, if you have any of these weird habits like I do, go ahead and drop a comment down below. Let me know. It doesn't matter, even if we have full-size bottles in the fridge, regardless of what it is, if you can get it for free. It is almost like a survival instinct is what they're kind of noting, that you unconsciously take a little bit extra. That way you have it just in case. Now, the second one, the good hand towels are an abstract concept. This is something very interesting because when you put towels out in the bathroom, majority of the time they're for drying your hands. Some people never use them. They have a secondary set of towels, and that's exactly what they're talking about. When someone comes over where you have an event, you put out the nicer things to impress, I guess, but you have kind of display towels that are never meant to be used. And then you have actual towels that can be used for everything, and they're not really used, again, those special towels, which is kind of crazy because I remember this in my household. When I was growing up, there was a set of towels that just hung there forever. And of course, there were other ones that we used to dry our hands. Now, looking at the third one, your relationship with leftovers is serious. Now, this is something that I have to chuckle and laugh about because wasting food is kind of crazy. When you think of a nation, we waste about 30 to 40% of our food goes in the garbage. I've always eaten leftovers. I've always had sandwiches. Leaving it in the fridge, a day or two, it's definitely reasonable when it comes to leftovers. But throwing away food makes me think of, really from the financial side, throwing away money. If you're buying food and then the next day you don't want to eat it, you toss it. Guess what? To me, that is throwing away money. It's really containers. When you look at a lot of different things, I want to do, and I have done the mathematical equations with, going out to eat and buying food that way versus making sandwiches, bringing my own lunch, which I do every single day, to really be kind of on that frugal aspect. And when we look at number 4, this is actually a pet peeve that I don't do anymore, and I do not like. Empty containers have second, third, fourth life. When you look at different things in different containers, the content is always not always the same as what is actually inside there. In this article, they talk about a buttered tub in the fridge. Surprising it's not. It's actually soup that we made. Every container is a potential storage solution, and your friends have learned that whatever is packaged in the fridge could not be the actual contents what is in there. Now, we've done this. We do a lot of meal prep, which means you're going in and you're using a lot of storage containers. You're also doing a lot of freezing. And of course, you can make sure, and you have to mark it. That way you know exactly the date you're putting it in there. And of course, when it has to be used by or when it's good by. Now, when we get to number 5, the DIY repair. This is something that I used to do a lot. In little things, I will absolutely start with the DIY. I will do it myself, little YouTube tutorials. Being able to do things myself, I do like it. I've gotten to the point where I see the value and I see really the reason why to actually have it professionally done and getting things done really properly. I might take an attempt to do things, but it might not come out the best. And especially when it comes to electrical, when it comes to plumbing, when it comes to upgrade, I don't want to jerry rig any solutions. I want them done and I want them done properly. Just like painting, I find the time, as much as people love to paint, I do not like painting at all. It is one of my pet peeves. I would rather pay somebody to paint everything in the entirety versus me having to paint it. Now, number 6, this is 100% me. However, definition of empty can defy physics. Shampoo bottle isn't empty. The toothpaste tube isn't empty. And it's kind of crazy because if you ever watch comedians, there is actually a very, very funny skit about talking about toothpaste rolls and talking about shampoo bottles. And it's from Nate Bargatze. It's pretty funny. So if you check it out, but going in there and making it almost the ability to put, and again, if you've ever done this, putting a little bit of water in your shampoo bottle, making sure you got every little last drop, taking that little tube of toothpaste, rolling it up, making sure that it's been through the torture chamber, that you squeezed every last ounce of that. And again, when it comes to that, it is the empty bottles where I know a lot of people, when it gets low, when it gets to that point, they throw it out. They don't even think second nature about it, but I always do. Number 7, unfortunately, is another one, the secret stash of just in case money. Everyone likes to have a little bit of cash around the house, and I do as well. It stays somewhere in your home. You have a little bit of emergency cash. Maybe it's an old shoe. Maybe it's in a box behind the freezer, a picture frame, whatever it is. Yes, a little cash is around in a couple different places in my house, and I know exactly where them are. And of course, number 8, now this again is something that we definitely focused on when I was younger, that I really intensified when it came to being older. Grocery shopping strategy is intense. Me personally, I make lists. Everything that I want from the grocery store, I do make shopping lists. I know the store layout. I know what's on sale. We know what is discounted. And we know, and I really do understand, I do not buy anything, I've stressed this before, outside of my list. If I have a list that has 10 items, I come back from the store with 10 items or less, depending what they had and what they didn't have. I don't do substitutions. I have, and I know exactly paying full price for something seems like it's almost overpaying for something because there are so many ways to get discounts. Now, for instance, we'll do some of the coupon clipping online. You can do it a couple different places, even like we do a wholesale with BJ's. You can clip coupons on there. Then, of course, you get a couple percentage back depending if you're ordering online from like a Rakuten, and then you do get a little bit of a rebate with the card that you're using. If you use debit cards or credit cards and debit card reward programs, you can save a couple kind of pennies here and there, a couple dollars here and there. But you know what? It adds up. When I look at the shopping bill and I go to checkout and I'm saving, 10, 20, 30 bucks off of our normal shopping bill. And then we also do get the rewards for being, perk members, having the cards. It does add up and it does make a big difference. Now, number 9, protective about a full tank of gas. This is something when it gets low, even in my fuel right now, when it gets to about half a tank, a quarter of a tank, I am completely filling it up. And every single time I stop at the gas station, I fill it up in its entirety. If you have ever, like me, ran out of gas in a place where you didn't plan for it, have to make sure that you have it and really have it prepared because you never know exactly when you're going to need it. Running that fuel to empty gives me complete and total anxiety when it comes to that, regardless really of what the price is. This is where if you need gas, I'm going to get gas. Of course, like I said, I go to wholesales. That way we have Sam's Club or we have BJ's that we can rely on. Now, number 10, your wardrobe has 9 lives. Now, this is something that the frugality really comes out of me. When it comes to clothing and when it comes to purchasing clothing, I am willing to spend more to get a much superior kind of quality of the clothing itself versus buying a lot more quantity. I don't want really cheap stuff because, of course, really cheap stuff for a majority of it doesn't last and it doesn't last long. When I start thinking of paying more for, let's say, my pants that I wear to work, I've worn them for years at this point, and you know what? They are still in very good condition. Could I replace them? Absolutely, but did I get the money out of them? 100%. I got every penny. Same with shoes. When it comes to shoes, I do buy more expensive, more comfortable shoes, but you know what? I buy them about every 3 years, which to me, when you dollar cost average over 3 years, it's charging me about $3 a month to have decent, high quality work shoes. But I think in the other side too, I don't have the back pain, I don't have the feet pain, I don't have a lot of things from buying cheaper products and making sure, again, that they are a little bit better quality to know what you're getting. Number 11, your gift wrapping skills include reusing paper. This is something literally that we have done forever when it comes to birthdays, when it comes to, gifting bags, when it comes to wrapping paper has come around and it has stayed around. When it comes to boxes, when it comes to bags, when it comes to recycling, yes, we have used it again and again and again. I think we even have some stuff for our kids that might be on the second or third life, but the wrapping paper itself is really still there and still around. But when you look at wrapping paper, it's now kind of crazy. Looking at Sam's Club, it's like $20, $25 for 2 rolls of wrapping paper. That's a considerable amount of money. And when you think about that $25, if I'm spending $25 on wrapping paper, that is $25 I cannot spend anywhere else. When the money is gone, that money is gone. And the final one I'm going to leave you with, the religion with free stuff. Regardless of where we go, regardless of the events, everything we do, it is almost again back to the primal need of the logic and the reason of, do we really need it? When you look at free food, when you look at free swag, when you look at a lot of events, promos, everything that we do get a incredible amount of free stuff. And it's interesting to see exactly how far you can take it. All right, guys, that is going to do it for today's video. Let me know in the comments any of these things that you have seen and experienced in your lifetime, and I'll catch you in the next video.